We're jumping straight into advanced micro devices today. Everyone is watching the price action, but the real story is the massive catalyst involving OpenAI and the shift in data center dominance.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get started, and believe me, we have a lot to unpack today, make sure you hit that subscribe button and give us a like. We're here to simplify this complex market for you.
And this is a complex one.
It really is. So let's just talk about the scale of what's happening. This isn't just about, selling chips for gaming consoles anymore.
No, not at all.
We are talking about a 6 gigawatt deployment, a $120 billion opportunity.
That 6 gigawatt number is, it's really the headline that matters.
Right.
To put that in perspective for everyone listening, a single gigawatt is, well, it's roughly enough energy to power a city the size of San Francisco.
Wow.
So when you talk about 6 gigawatts, you're talking about the power infrastructure for 6 major cities, all dedicated to AI.
That is just a staggering visual. It's not just a tech upgrade anymore.
No, it's an industrial revolution happening in real time.
And what really strikes me is the validation part of this. For so long, the question was always, can anyone actually catch the market leader?
Right. Can they compete?
But when you have the most demanding AI user in the world, OpenAI, making a bet of that size,
Yeah.
the question changes, doesn't it?
It completely shifts. It's not can they anymore. It's how big will they get?
It's a total paradigm shift.
And, well, we have to start with the bull case because the numbers from 2025 were just staggering.
Yeah.
Revenue hit over $32 billion.
Which is nearly 35% year-over-year growth. That's huge.
It is, but you know as well as I do that headline numbers can be a little deceiving.
Right, you have to peel back the onion. If you look at their gaming revenue, for example, it's been a bit soft.
The console cycle is getting old.
Exactly. People aren't buying as many consoles right now, so the growth isn't coming from there. The rocket fuel is the data center.
Precisely. It's the quality of that revenue. The data center segment is targeting, what, over 60% compound annual growth?
60%. That's hyper growth for a company this big. You just don't see that.
You don't. It's like a large cap company sprinting like a startup. And that brings us right back to that OpenAI partnership we mentioned.
This isn't just a press release.
No, this is hardware in racks, burning power, crunching data. It's real.
And that creates a sticky ecosystem, right? Once they optimize their models for this hardware, they aren't going to want to switch back and forth.
It's a huge switching cost. It creates a baseline of demand and I think gives other big players like a Microsoft or a Meta permission to diversify.
It's like social proof for billionaires?
It is. It validates the whole platform. The old argument was always that the software just wasn't there.
Or the hardware wasn't quite as good for training.
Right. But if you have a $120 billion pipeline with the creators of ChatGPT, well, that argument just falls flat.
Yeah, that pretty much settles it. It proves the hardware works for the heaviest workloads imaginable.
And maybe more importantly, it gives these hyperscalers a way to stop being so dependent on one supplier.
That leverage is huge. These companies hate being held hostage by a single supplier.
They want competition.
Okay, but I want to pivot to the secret sauce here, the technology moat. We hear this term chiplets thrown around.
Wow.
It sounds like a snack food to me.
It's arguably the smartest strategic move the company has made in a decade. It fundamentally changed the economics of making chips.
So break that down for us. Why is this chiplet thing such a big deal?
Sure, let's use an analogy. The old way of making a chip is like baking a massive single wedding cake. A monolithic die.
Okay.
You pour all your silicon into one giant mold. But manufacturing is never perfect. You always get tiny defects. If you get one defect in that giant cake,
You have to throw the whole thing out.
the whole thing. And it is astronomically expensive. As chips get bigger for AI, the odds of a defect just go up and up.
So what did they do differently?
They decided to build with Lego blocks. Instead of one giant chip, they make smaller modular pieces, the chiplets.
I like the Lego analogy. That makes sense.
It fits perfectly. If one little Lego block has a defect, you just toss that one block. Your yield, the number of good chips you get, goes through the roof.
But it's not just about cost, is it?
No, it's about flexibility. They can stitch these chiplets together. They can mix and match a CPU, a GPU, and an FPGA that's a programmable chip all in one package.
And just to clarify for our listeners, an FPGA means the hardware can be reprogrammed after it's built.
That's right, field programmable gate array. It means you can update the chip's function as AI algorithms evolve. It's incredibly adaptable.
So if Microsoft comes to them and says, hey, we need a chip that's 80% AI and 20% general compute,
They can just swap out the Lego blocks and build it,
whereas the competition would have to design a whole new wedding cake from scratch.
which could take years. And this is why we've seen such a massive market share shift in the data center. They have just been eating their old rivals' lunch.
They've captured, what, nearly 40% of the server CPU market now.
Almost 40, with their sights set on over 50. That was unthinkable 5 or 6 years ago.
I remember when they were in the single digits, people thought they were going bankrupt.
It's an incredible turnaround.
But let's address the elephant in the room, the CUDA moat. The bare thesis for years has been, sure, the chips are good, but no one uses the software.
That moat is drying up. And it is drying up faster than people realize.
How so?
They've rolled out ROCm 6.0, their open software stack. But the key data point, really, is that it now supports 95% of PyTorch and TensorFlow models right out of the box.
And let's translate that. PyTorch is basically the language almost all AI researchers are using now. It's like the English language of AI.
You got it. Think of PyTorch as a universal translator. Before, it only spoke NVIDIA. Now, it speaks AMD fluently.
So a developer doesn't have to rewrite their entire code base just to use a different chip.
Exactly. It lowers the switching cost dramatically. For a company like Microsoft spending billions, if they can save 20 or 30% on TCO,
And the software migration is easy.
it's a no-brainer. That's why we're seeing that $120 billion pipeline. The technical barrier is just vanishing.
And that all trickles down to the bottom line. I was looking at the margins, and they are expanding.
They are. Gross margins hit 55.8% recently. That's a direct result of selling more of these high-margin data center chips.
The MI300X and the new MI325X.
Exactly. These are premium products. And on top of that, their balance sheet is pristine. They have a net cash position.
So they can fund all this R&D without taking on a bunch of dangerous debt.
Right. And management has that target out there, over $20 in non-GAAP EPS long term.
Which, if they hit that, makes the stock look very different today. But hold on. We're getting a little too excited here.
It's easy to do.
It's the easy money show, but we have to be real. There are significant risks.
There are absolutely risks, and we have to talk about the gorilla in the room.
NVIDIA. They aren't exactly known for slowing down.
They're relentless, and they have pricing power and margins that are, well, they're unheard of for a hardware company.
So the risk is they start a price war.
If they feel their market share is truly threatened, yes, they could slash prices on their Blackwell chips. They have the margin buffer to do it.
And that would make life very difficult for the challenger.
Very difficult. And there's still the performance gap argument for the absolute hardest training workloads.
The competitor still holds the crown.
For raw absolute performance on some of those frontier models, yes. If you need to train a model as fast as humanly possible, cost be damned, you probably still go with the leader.
But the market is shifting more to inference, right? The actual running of the models.
Correct. Training is teaching the brain. Inference is the brain answering questions. And for inference, the TCO and performance gap is much smaller, or even favors the challenger. But the perception is still there.
Okay, let's talk geopolitics. The sword hanging over this entire sector. Export controls.
It's unavoidable. The China factor is huge. A large portion of potential growth relies on being able to sell reduced spec chips to Chinese data centers.
The ones that are artificially slowed down to comply with regulations. Right?
Exactly. But the risk is that the administration could tighten those regulations even further. We're in a tech Cold War.
So one signature on a piece of paper in D.C. could just evaporate billions in revenue overnight.
That's the risk. It's a binary risk you just can't model. And then you have the physical risks, the supply chain.
They don't make their own chips. They're fabless.
They rely entirely on TSMC for their most advanced 3nm nodes.
And for that special packaging we talked about, the CoWoS.
Yes, the glue that holds the chiplets together. The problem is, capacity for CoWoS is incredibly tight. Everyone is fighting for the same manufacturing lines at TSMC.
A single point of failure for the whole AI economy.
It really is. And on top of that, you have the memory bottleneck, the HBM shortage.
High bandwidth memory.
These AI chips are like Ferrari engines. You can't feed them with a garden hose. HBM is the fire hose. But the whole industry is fighting for supply from just a couple of companies.
So if they can't get enough HBM, they can't ship their new chips, period.
Doesn't matter how many orders they have. It's like having a car with no steering wheel. You're not going anywhere.
And that leads to the final macro fear, the AI bubble anxiety. Are we getting ahead of ourselves with this spending?
Well, the projection is $1.3 trillion in industry-wide spending in 2026.
That number doesn't even sound real.
It's a staggering amount of capital. And the fear is that the infrastructure spending is getting too far ahead of the actual monetization.
Are these companies actually making enough profit from AI to justify it?
And if the answer is not yet, they could just pause, stop buying chips to digest what they've already bought. And in a downturn, the number two supplier always gets hit harder.
The classic semiconductor boom and bust cycle?
It's almost a law of physics.
Okay, so for our listeners trying to make sense of this right now, what should they be watching in the next few weeks?
Well, earnings are just around the corner, late January or early February. That's the immediate catalyst.
And what's the one number to watch?
Ignore the noise. Look straight at the data center revenue guidance. That is the heartbeat of this whole story. Guidance tells you what their biggest customers are planning to spend.
So not what they did, but what they're going to do.
Exactly. And also listen for updates on the Instinct accelerator ramp. Are they beating that $2 billion quarterly run rate target?
Got it. Data center guidance and the Instinct run rate. What about on the product side? I keep hearing these cool code names.
Yes, watch for news on the MI325X ramping up. That's the one with the massive memory bandwidth. But also, listen for mentions of Gorgon and Medusa.
Gorgon and Medusa. Sounds ominous.
In this case, it's good news. Those are the code names for their next-gen AI PC platform for 2026. This is the Edge AI play.
Running AI locally on your laptop, not just in the cloud.
Precisely. If they can show leadership there, it opens up a whole new revenue stream. It proves they can win on both fronts, cloud and client.
And finally, the macro picture. What's the Fed doing?
As a high-growth stock, it loves lower interest rates. Watch the Fed's moves in Q1. And going back to geopolitics, watch for any rumors about those China export licenses.
A license getting approved would be an instant upside trigger.
It would. It's not fully priced in.
So let's wrap this up. It seems like the company has truly transitioned from being the value alternative to a performance leader in the most critical part of the economy.
That's the key takeaway. They have moved up the food chain. They are not just drafting behind the leader anymore. They're carving their own lane.
And here's the final thought I want to leave you with today. Everyone is obsessed with who has the fastest chip right now. But think about this. With a $120 billion pipeline locked in with OpenAI, and an architecture that lets them adapt faster than anyone, has advanced micro devices already won the war for the next generation of AI infrastructure without the market fully pricing it in yet?
That is the question. The market often looks in the rearview mirror, but the pipeline tells you where the road is going.
We'll catch you on the next one. Keep it simple.
Thanks for listening.